The Financial Planner, presented by BSC, Investors Protection Fund.
Hello and welcome. You're watching Financial Planner. Over the next 30 minutes, we'll talk about one of the most basic but, of course, interesting subjects in financial planning, which is what is mutual fund. And, of course, we'll delve a little more into what global funds are all about as well. To talk about that, we have Nelson D'Souza, General Manager of fundsupermart.com, joining in our studios. Thanks, Nelson, for coming by this afternoon.
My pleasure.
Nelson, to begin with, mutual funds. I mean, you hear that word every time you mention personal finance.
Right.
It's as basic as a mutual fund, but tell us all about it, because it can, of course, get very complicated if one doesn't understand it.
Well, I think in our country, mutual fund seems to be one of the most complex investment options that are available. But the fact of the matter is that mutual funds are probably meant to be less complex. They were invented way back in the Western world to make it easier for the middle-class working population to save time and energy and invest without having to worry too much about investing. I think, unfortunately, in our country, it's not had the same impact it's had in the rest of the world. To make it very simple, a mutual fund is nothing but a fund which is managed by a professional fund manager who understands markets, who understands various avenues of investment, and manages money on behalf of everybody professionally, so that in the end we are able to generate better returns and are able to manage markets very well. And that is the simplest definition of a mutual fund. The structure of a mutual fund is probably complex, but I don't think if we get into that, it'll make anybody's lives easier. But I think the most important aspect of a mutual fund is that it is a fund which is meant for the common man. It's meant for everybody who has not got the time and the energy to look at investments. And to me, that is the simplest way of understanding and making someone understand what a mutual fund is.
Nelson, but there are so many funds out there promising so many investment styles and strategies. Some are new, promising, some are old but floundering.
Right.
How does one really determine? Because as a retail investor, you might actually be ill-equipped to go out there and determine what is a good fund for you. I mean, more often than not, we go after past performance, right? Because, of course, history is the best way to determine what your future could be.
Correct. I think the easier way to figure what is the right kind of a fund will probably come through the understanding of what are the two major categories of funds that you have. While it comes to mutual funds, we categorize mutual funds as either equity or as debt funds.
So that goes back to your asset allocation goal.
That's correct.
Okay,
Yeah,
so once you determine that, and then you come back to selecting a fund.
Yes. Now, while you do that, you also should know that there is something in between equity and debt, and that is the balance category. So if you can understand these three categories, you know for a fact that mutual funds are largely of three types, and then you can decide what kind of a fund you want to get into depending on the amount of risk that you want to take. So if you're very risk averse, then it should be a debt fund. But you have the capacity to take risk, then it should be an equity. But if you're in between, then it is a balanced fund that you should look at. So I think that will be an easier approach to understanding what works better for you than just looking at various different definitions of mutual funds in the industry.
Right. Also, very often than not, I mean, we're talking about asset allocation. A lot of people get carried away. You might invest in a diversified fund if that's your goal. So, of course, then you leave it to the fund manager to determine where that money is invested. Some people might go after a mid-cap fund. Some people might look at a sector-specific fund. You know, you could have no exposure to equity mutual funds, and you might still go out there being extremely risk-averse and buy a sector fund. So how does that actually play out when you determine the vertical of mutual funds that you want after you get down to debt and equity?
Well, see, if you're talking about a sector fund, it is probably the most riskiest aspect when it comes to a mutual fund, because you're actually putting all your eggs in one basket. When you talk about a sector, you're putting your money in one single asset class, one single sector. For example, go back to 1999 when you had the IT boom and suddenly it all went away. So anybody who invested money in an IT mutual fund those days lost money. That simply tells you that if you had to put all your money in one single sector, you would actually lose money. So then look at the other extreme. You have the diversified category of mutual funds. Why would you put it there? You would put it there because you want to spread your risk across different various sectors. And you can put that in the connotation of eggs in different baskets, right? So that works for you when you have a better understanding. I would say that a sectoral fund will work for someone who understands the sector. A diversified fund will probably work for someone who's probably not got the time and energy to dedicate himself to various different sectors which work in the market and leave that headache of figuring that out to the fund manager. So that's an easier way to, you know, differentiate between a sectoral and a diversified category.
So the best way to start, if somebody's looking at investing in an equity mutual fund for the very first time, you'd advise them to go after a diversified mutual fund as opposed to going sector specific or doing a top-down approach?
Yes, diversified or a large cap mutual fund. Again,
Those are the ones that
another way of looking at mutual funds is to differentiate them between various different categories. So you have large cap, you have the mid cap, and you have the small cap. It will again play out in the same way as equity, balanced, and debt. So if you are into large cap, then you're obviously in a more safe and secure space. If you're in a mid cap space, you're in between, and if you're in a small cap space, you're taking more risk. And obviously the payoff of taking risk is always there. So you make more money if you're taking more risk, make much lesser money if you're taking less risk. And that's another way to understand the risk aspect of various mutual funds.
You know, most people would say that it's important to stick to funds that are above average in terms of their performance rating. How does one determine it? Would you look at past performance? So if I had to ask you, what are the key factors to watch out for? Past performance would be quite crucial, right?
Correct, yeah. But past performance obviously does not mean future performance. That's very important to understand. Past performance for most mutual funds would tend to be very good if you look at the last decade. Leave the last 3 years, but if you go back and see before 2008, 2007, performance would have been very good. But you look after that for the next 3 or 4 years up to now, you'll find that they haven't been very good. So past performance necessarily is proven to be not one of the single parameters to judge a mutual fund. You should also be looking at many other aspects: track record of the fund manager, the track record of the fund house, the quality of the fund house in terms of how long it's been around and what kind of funds, how many of their funds have managed to deliver over a period of time. You should also look at the fact that there should be consistency in the performance of the funds.
How does one determine that? Because if you take a look at the league table or a mutual fund comparison, in the last 25 years, there's not been one single fund that has stayed on the top, because different funds perform in different cycles of the market or the economy, right?
That's right. So you can't really have a mutual fund performing all around, all through. It has to obviously go down and up. Unless that happens, markets don't work. That means what comes into play is asset allocation, and that's why you need to have more than one fund, and you should have more than one type of a fund in your portfolio. That means you should spread your money across various different funds. So one should have large cap, one should have mid cap, one should have small cap. Depending on the amount of risk, he should spread the allocation accordingly, and that will determine overall your portfolio. Just looking at one single sector, one single fund, or the fact that we're expecting a fund to go on forever and deliver is not going to be the case for anybody.
Nelson, you might determine that you want to invest in a given fund, and in your opinion, that could be the best one available.
Right.
But more often than not, there'll be another fund which will be exactly similar, investing in pretty much the similar sort of stocks or sectors that you're talking about. So how do you determine the performance ranking? Would you look at which mutual fund is rated higher? Would you go back and look at the league table? Because if you've got two very similar funds, how do you make that call?
Well, very often while I sit down to research and look at a few funds for our own clients, I do come across this one crossroad where I have to choose between two very similar looking funds, and that's when you have to take a judgmental call. Although you do a lot of analysis, you do a lot of quantitatives, it is also up to the financial planner, or sometimes even up to the fund manager, to take some calls. So you can't always completely judge everything based on quantitatives. To a large extent, some amount of that gut goes in to decide when you have two similar looking funds where every single parameter matches up.
And more than likely you'd get that, right? I mean, you'd always copy a success story.
Yes.
Nelson, we were talking about, you mentioned the quantitative factors.
Right.
Going to qualitative factors, so fund managers' quality of investing. You did mention that you've got to look at what the fund manager's style of investing is, what his objective is. How does one determine that? What are the factors to watch out for in terms of the qualitative analysis of picking a fund?
Well, first and foremost is to understand how long is the fund manager been doing this. What are the kind of various funds that he's handled? If he has moved on from one fund house to the next, what kind of fund houses have they been? How consistent is he in terms of staying on? This would be a very crucial aspect when it comes to the qualitatives. In addition to that, it is also about how many times he's gone right with his calls. Very often we find that you have the flashes in the pan when it comes to fund managers and sometimes even funds. So you'll have to watch out for that and see if this is just a stroke of luck, or has he actually managed to deliver consistently. So these will be a few aspects that you'll have to consider.
Nelson, very quickly, how important it is to determine whether the fund that you're investing in is fairly large or not very large? How does that come into
It's very important to know whether the fund is very large or not, because if the fund is too small, then there is a level of risk, because if a few more investors decide to take their money out from that fund, the whole fund strategy goes for a toss. If the fund is too large, then sometimes it becomes very hard for the fund manager to manage efficiently, and hence it's very important that you understand the size of the fund. We generally recommend that if the fund is too large, then try and be careful when you're taking the call to invest there. If it is too small, try and stay away, because the fund might not have necessarily performed or might not perform, and might have the risk of investors pulling out money and then risking the entire fund altogether.
Nelson, how often you recommend investors to review their mutual fund portfolio? How often should you consider dropping a laggard or investing into a fund that's actually performing? Because a lot of people we talk to are struggling because a lot of the investments are not reaping them any benefits.
True. And I
know you need to be a long-term investor, but where does that distinction come?
Well, you see, this is a common problem around the world. Wherever I've been, people tend to have the same problem. They probably have picked up the right fund. It did well for a while, and then suddenly it slipped. And they wouldn't know, what is that they did wrong. I think the fundamental mistake has been in reviewing the fund at least once a year. So I would say, review your fund at least once a year and look at it and see if the performance is consistent or not. If it is not, look at that particular fund which isn't doing too well carefully, and then choose another fund if you're not too happy with it, and go on doing this throughout the financial planning process.
Nelson, another important topic that I want to touch upon that doesn't get talked about very often is investing in a global fund.
Right.
I mean, most of us are very apprehensive to invest anywhere beyond the border of this country, for good enough reason. I mean, India is a growing country. You're talking about a double-digit growth.
Right.
You're talking about one of the countries that most people abroad would be betting big on.
Yes.
Why should one even consider a global fund, and what is a global fund to begin with?
Well, a global fund is a fund which invests money into various different economies around the world. For example, lately we've seen a US blue chip equity fund that's come out from ICICI Prudential. This particular fund goes back to invest money in NASDAQ listed stocks. NASDAQ, which is one of the exchanges in the US. So basically, you invest your money in an emerging, not an emerging, but rather a developed country like the US, and make the most of the progress that that particular country makes. So you have a China fund today, you have a Brazil fund.
It's all about diversification.
Yeah, you're basically diversifying your money across globally rather than just put your money in India. If I could give you a quick piece of information, this year, at the beginning of the year, incidentally, most top performing funds were global funds. And for those smart investors who managed to put their money into global funds, they were actually able to reduce the shock of a fall in markets at any stage, largely because, they had global funds in their portfolio.
So it obviously balances off.
Yes, yes. So essentially, the message is, if you could invest your money into global funds, you're actually bringing in a larger level of diversification to your overall portfolio. The level of allocation to an international economy will increase, and you will not just be in India, and you're reducing the shock of India going into a downturn, which is probably what we're going through right now, and reduce any amount of negative impact on your portfolio.
But you also bring in currency risk.
There is obviously currency risk, because unlike most countries that I've seen, India is not pegged to the dollar. If India's currency was pegged to the dollar, maybe you wouldn't have had that risk. But because we are not pegged to the dollar, if the dollar tends to increase or decrease, we will have an impact on the mutual fund portfolio itself.
Also about know-how, right? I mean, it's hard enough for a retail investor to know what's going on in the Indian economy.
Correct.
Taking a bet on a China, or for that matter, taking a call on a blue chip or listed on the NASDAQ, gets very complicated.
Well, that's why you have a fund manager.
And therefore the apprehension, I guess.
Yeah, all you need to remember is that at the end of the day, it's a mutual fund, and there is a fund manager who will take care of the money for you. Secondly, most importantly, because you're doing an overall allocation of your total portfolio, you don't need to really worry about it, because going by the fundamentals of financial planning, it's important that you spread your money across these various different economies. So while you're doing that, you really don't need to worry, because you are safe in the hands of a fund manager. And most importantly, you're safe because you've allocated your money right across various different asset classes.
Nelson, how much percentage of your mutual fund exposure should one consider taking exposure to a global fund?
I would say between 5 to 10%.
At best?
At the best.
Which are the top global funds right now? Could you share that with our viewers as well?
Well, there has been a Mirae Asset China Advantage Fund that we've been looking at for quite some time. It's done very well. We have a few from Franklin Templeton. There's one from Brazil, for Brazil that we've had. The latest one that has come from ICICI Prudential, the US Blue Chip Equity Fund, is one of the latest that has been recommended by most financial planners and advisors. So I would say that would be, if anyone is interested right now, then please certainly look at the US Blue Chip Fund at the moment.
That's, of course, all about mutual funds and all about global funds. So if you are risk averse, you need to go out there and invest in a global fund. It does not mean you're taking on more risk. All it means is that actually diversifying your portfolio and not just betting on India, but betting on the world economy, if I can call it that. We'll take a break on that note. We'll come back and take up all your financial planning queries.
The Financial Planner, presented by BSC, Investors Protection Fund.
First up, we've got a query from Mr. Seth, who writes in. He says he's a 61-year-old retired person, Nelson. He lives in Rajkot. He's got no liabilities as his sons are already settled. He's retired from a bank and has a monthly income of about 45,000, where 20,000 is pension and 25,000 is interest income that he's making. He's already invested in a bank FD. He expects about 20,000 of monthly expenditure. What should he be looking to do, and how much and in what shape should he be investing in a monthly balance income, is what he's asking us.
Right, straightforward. Well, I think here is a case where the man's well settled, he's done with his liabilities, gone straight into retirement and planned himself very well. I must tell you, when I look at it, I feel that he's one of those smarter investors that we look for as financial advisors. Here he's got about 20,000 left behind after taking out his expenses, 25,000. I think what is left behind, because he's got 45,000 rupees which comes in every month for his from his pension and his interest. Obviously he's invested money in fixed deposit, which is obvious from the interest question, and there is left behind money of 25,000 which needs to be managed and invested. I would recommend to the gentleman that he looks at monthly income plans. Monthly income plans have 15 to 25% of money in equity and the balance in debt. Now ideally most financial advisors do not advise older folks, people who are into retirement, to invest into equity. But the fact that he's more or less managed himself very well and he has spare money, I would want him to avoid getting into a reinvestment risk after a few years, because right now his money is in fixed deposit. That means a few years down the line, when rates go down, that income will go down. And in order to try and avoid that shock when he's done with those high rates, he should look at some amount of money in equity. And that's why a monthly income plan, which has an element of equity in it, that should help him. It will also give him regular tax flows, regular cash flows, which will help him. The other aspect here is that it will help him in terms of managing his taxation aspect, if there is any, in case, you know, he's got other incomes also. One recommended plan that I have for him is the Reliance monthly income plan. He should put his money there. I wouldn't recommend another fund, because these are very safe investment options. You don't need to have allocations and diversifications here. So, yeah.
Nelson, next we've got a question from Rahul, and he says, is it a good time to invest in a liquid gilt mutual fund? If yes, would you suggest a lump sum or an SIP? And of course a good liquid gilt fund, if you actually advise him to go for it. The reason I think he's asking why a liquid gilt fund, more importantly why a gilt fund. You see, gilt funds are typically government security investment options which are made available through a mutual fund route. Typically when interest rates start to tank, which start to go down, people tend to look towards, which is what's happening currently. They'll start to look towards government investment options such as GSECs, which come through the gilt route. Here is this question, because this gentleman has probably seen interest rates going south, which is what we think it should be this year. But unfortunately, we are not too sure if that is happening. If you look at the last week's news item, SBI had actually increased its interest rates by about 25 bips. And that was surprising, because most people would believe that interest rates going down. But here's the case, you know, where we're not too sure, because there is a crisis going on in the country. Ideally, most people in these times would look at the long-term debt funds. But since there is no clarity, we've been recommending, as financial planners, the short-term debt fund route. I would recommend, if he's looking at the short-term debt fund route, then look at the Templeton India short-term income plan or the DWS short maturity fund plan. The other aspect of this question is that he's looking at liquid funds. Now, I'm not too sure if liquid funds are the best way forward, because liquid funds are typically an alternative to savings accounts. So people want a lot of liquidity. Liquid funds tend to have far more taxation compared to debt funds. I have another alternative. The alternative is the ultra short-term debt fund route. If you could look at that instead of the liquid gilt fund, I think it should do good for him. Templeton India ultra short-term bond fund is the best fund in this particular category, according to me. And I think that should be the solution to his problem. Right, Rahul, that's your question answered right there. We'll take a break. We'll come back and continue taking up your financial planning queries, so stay tuned.
The Financial Planner, presented by BSC, Investors Protect.
Welcome back. You're watching Financial Planner. Nelson, we've only got time for one quick question. But viewer writes into us saying his LIC Market Plus policy matured in August 2011 and he hasn't received any payments from the company. What should he be looking to do?
Well, he should contact the customer care for LIC, or probably go to the nearest LIC branch, or simply put, I'm sure he's bought it from an advisor. Go contact the advisor and tell him this is the case, and I'm sure he should be able to get some help.
But given that it's matured almost a year ago, is that going to be a problem?
It shouldn't be a problem.
Normally, how long does it take for the payments to come through?
It depends from insurance house to insurance house, so I really can't comment here because it is a part of the process the insurance company takes up. It depends on the claim process, depends on if it is a claim, if it is a maturity, maybe it's a very different process. By and large, it shouldn't take too long, but I'm guessing there's been some trouble here, so he might have to go back and check quickly.
And more often than not, the taker needs to be chasing up or following up with the insurance company.
That's correct, yes.
So that is obviously a bit of a problem that we all get caught up in, and not realizing that it turns the other way around when you're exiting a fund. Yes. But very quickly, what is your take on the LIC Market Pulse policy? It's a good policy, so I'm guessing if people are looking at an LIC insurance policy, they shouldn't get...
Yes, it's one of those market-linked policies that you have. As a financial planner, I'm not too bullish on market-linked products, but yes, if he's already bought it and
he's out of it now,
he's out of it, it's good for him. I'd say that.
Investment Ladder, presented by BSC, Investors Protection Fund.
Well, that's the advice coming in for you, Shankar, if you're watching. That's also the time we have on this edition of Financial Planner. Thanks for watching.
The Financial Planner, presented by BSC, Investors Protection.
Presented by BSC Investors Protection Fund.